If you've owned your home for a few years and its value has gone up significantly, you might be wondering how much tax you'll owe when you sell. The answer for most homeowners is, a lot less than you think. There's a massive tax exclusion buried in Section 121 of the tax code that eliminates up to $500,000 in capital gains entirely, and most people have no idea how it works. Section 121 of the Internal Revenue Code lets you exclude up to $250,000 of capital gain if you're single, or up to $500,000 if you're married filing jointly, from the sale of your primary residence. This is not a deduction, it's an exclusion, meaning that gain never shows up as taxable income at all. To qualify, you need to meet two tests, the ownership test and the use test. Both are based on a 5-year window looking back from your sale date. The ownership test requires that you own the home for at least 2 of the last 5 years before the sale date. The use test requires that you lived in the home as your primary residence for at least 2 of the last 5 years. The 2 years don't have to be continuous, they just have to add up to 24 months within that 5-year window. And the ownership and use periods don't have to overlap with each other, though for most people they do. If you're married, only one spouse needs to satisfy the ownership test, but both spouses must independently satisfy the use test to claim the full $500,000 exclusion. Your capital gain is not simply the sale price minus what you paid. It's the sale price minus your adjusted basis, and your adjusted basis is what most people get wrong. You start with your original purchase price, then you add any capital improvements you made over the years, a kitchen remodel, an addition, a new HVAC system, or roof replacement. These permanent improvements increase your basis and reduce your gain. You also add qualified selling costs, real estate agent commissions, legal fees, transfer taxes, and certain staging costs. The result is your adjusted basis. Subtract that from your net sale price and you have your actual capital gain. If you inherited a home, the rules are very different and very favorable. An inherited home receives what's called a stepped-up basis, which means your basis is reset to the fair market value of the property on the date of the original owner's death, not what they paid for it decades ago. So if your parent bought a home for $80,000 in 1985 and it was worth $450,000 when they died, your basis as the heir is $450,000. If you sell it shortly after for $460,000, you only owe taxes on the $10,000 gain, not the $370,000 in appreciation that happened during your parent's lifetime. Not all home sales qualify for the full exclusion, and this is where people get tripped up. If you converted part of your home to a rental or ran a business out of a portion of it and took depreciation deductions, that portion of the gain does not qualify for the Section 121 exclusion. The depreciation you claimed must be recaptured at 25%. For example, if you rented out 20% of your home for 3 years, roughly 20% of your total gain is allocated to the rental portion and is taxable, both depreciation recapture and any capital gain on that portion. What if you need to sell before you've lived in the home for 2 years? The IRS allows a partial exclusion if your early move was due to a qualifying hardship, a job relocation requiring a move of at least 50 miles, a health issue requiring the move, or an unforeseen circumstance like divorce, death, or natural disaster. The partial exclusion is prorated based on how much of the 2-year requirement you satisfied. If you lived there for 12 months out of the required 24, you qualify for half the exclusion, $125,000 single or $250,000 married. Even if your entire gain is excluded and you owe $0, you may still need to report the sale on Schedule D of your tax return. If you received a Form 1099-S from the title company, which is issued when the sale proceeds exceed $250,000 for a single person or $500,000 for married couples, the IRS will expect to see it on your return. You report the sale, claim the exclusion, and show zero gain. Failing to report because you think you don't owe anything can trigger an IRS notice asking you to explain the unreported sale. The single most valuable thing you can do starting today is keep a home improvement log. Every time you renovate a kitchen, add a bathroom, replace a roof, put in new windows, or make any other capital improvement, save the receipts and note the cost. These improvements increase your adjusted basis and reduce your taxable gain when you eventually sell. A homeowner who has $150,000 in documented improvements has $150,000 less in taxable gain. Over the years, this record-keeping habit can easily save you tens of thousands of dollars. Bottom line, most homeowners who have lived in their home for 2 or more years will owe little or no capital gains tax when they sell, thanks to the Section 121 exclusion. But the exclusion only protects you if you've tracked your basis correctly and avoided triggering the rental or business use exceptions. Talk to a tax professional the year before you plan to sell, not the year of, so you have time to make any adjustments that can improve your outcome.